Hello, hi dear students. Today we'll go through step 4 of business combination accounting, which talks about valuation of goodwill and the bargain purchase. So let's go through what is goodwill and what is bargain purchase. So goodwill will arise when we pay, the acquirer pays in excess of the consideration paid over the fair value. So that's a situation where we will have the goodwill. And the next thing is on bargain purchase, which is quite opposite of goodwill. So here there will be excess of fair value over the consideration paid. So this you will have to be a bit more careful. So when there will be situation of goodwill and when there will be situation of bargain purchase. So I'll try to give few examples in this chapter so that it will be more clear to you. So if you see example 1, we take this example. So net fair value of the assets acquired in business combination, let's say it's 100. Over the consideration paid by the acquirer to the acquiree is 120. So here we have more consideration paid than the fair value taken over as part of business combination. So 120 is the fair value as part of a business combination assets taken over, but consideration paid is 120. So there is more consideration paid than the fair value. So which means there is a payment towards goodwill. So here in this example, 120 being the fair value of the net assets acquired by the acquirer, and 100 is the consideration paid. Okay, so there is a situation of 20 here. Okay, I'll repeat, 120 is the concession paid and 100 is the net fair value of the assets acquired. So there is a case of goodwill of 20. Then if you go through example 2, say this is the example with respect to bargain purchase. The term bargain purchase comes because the acquirer acquires more of fair value assets, but he pays less. So which means he bargains on the consideration payable and then effectively he pays less than the assets, the fair value of assets acquired. So in those situations we call it as a bargain purchase. So in this example the net fair value of assets acquired is 120 and consideration paid is 100. So the fair value is more and consideration paid is less by 20. So the bargain purchase 20 is a gain to the acquirer. Okay, so then we'll go through one more example. So please read this example and I've given the summary of the question. So entity X planning to acquire entity Y in this example, and entity Y has multiple divisions of business, and the competition commissions in UK issued order to sell one division of entity in order to contain the competition, and the entity Z ultimately purchased that one division from entity Y. So this is a situation. So here we'll assess whether there will be goodwill or a bargain purchase in this example. So we can see this is a kind of distress sales because when entity X planning to acquire entity Y, there is a condition imposed by the competition commissions in UK that one division of Y needs to be sold before the acquisition happens or within certain timeline post the acquisition. So given the situation, of course, entity X will not pay more than the fair value of the assets acquired from Y because it is ultimately cannot use those assets to run the business because there is a restriction that one division needs to be sold within a certain period of time. So using this trump card, entity X can bargain to entity Y to pay lesser than the fair value of the assets acquired. So we can conclude this situation would lead to bargain purchase rather goodwill. Okay, then we'll move to next example. So please read this example as well. So the summary of the question here is A Limited acquires 80% equity of B Limited and consideration fixed at 15 crores and fair value of net asset is 20 crores and fair value of non-controlling interest which is 20% given at 4.2 crores. So here we'll have to calculate whether it is the goodwill or business combination, and if so, how much. So here the fair value of the total net assets of B Limited given as 20 crore, and from this 20 crore we'll have to reduce the non-controlling interest fair value, which is already given at 4.2 crores, which is the remaining 20% shares. So which means the net fair value of assets acquired by A, which for the 80% of its shares will be only 15.8 crores, 20 crore minus 4.2 crores. So, but consideration paid is only 15 crores. So, which means entity A acquires or take more fair value of assets, but the consideration paid is only less. So, fair value of assets is 15.8 crores, but consideration paid is only 15 crore. So, there is a gain of 80 lakhs. So we can conclude 80 lakhs will be the bargain purchase in this case. Okay, so just a note on bargain purchase. So before the acquirer accounts for the bargain purchase or the gain from on account of bargain purchase, they have to be little bit more careful that the gain is properly estimated, properly valued. Otherwise, it could lead to a situation that a kind of bogus gain might be recorded into the books. So that will not be allowed as part of the accounting guideline. So all the fair value estimates needs to be properly validated, and then only the gain from business combination needs to be accounted for. So in this case, the gain of 80 lakhs it can be accounted as non-comprehensive income, and finally it will be disclosed as capital reserve. But the point here is that 80 lakhs before it's recognized as capital reserve in the books of company A, all the valuation needs to be properly validated. If required, a third party valuer can be appointed by company A to ensure that the valuation is proper, and they can use all those valuation report during the audit time. Okay, then let me move to the next example. So in this example, entity X acquires 100% equity of entity Y on 1st April 2021, and the preliminary assessed fair value of the net asset is 100 million, and debt tax assets on the loss not recognized. So you know that there will be a situation where if the entity carries accumulated loss but don't have sufficient profit to offset, and in their tax return there is a carry forward loss. So ideally all these carry forward losses can be set off against future year profit if the future year the firm is confident to have the profit. But in this situation, they have given deferred tax asset not recognized, which means entity X concludes as of the date of acquisition that entity Y may not make sufficient profit to offset all those deferred tax asset. So that's why the deferred tax asset has not been recognized as on the date of acquisition. And purchase consideration is fixed at 150 million. But subsequently, post acquisition or within 1 year from the date of acquisition, entity Y wants a significant contract on 31st March 2022 that will ensure to set off all the deferred tax asset on the losses, because the significant contract booked will give sufficient profit over the period of time. That profit can be offset with the loss accumulated, so that the deferred tax assets can be effectively utilized. So that's a situation within 1 year from the date of acquisition. So now the question is whether the deferred tax assets can be recognized as part of the purchase consideration. But of course, at the time of purchase consideration, at the time of business acquisition, there is no clarity that entity Y will win a contract, this kind of a significant contract, and even there is no indication that there will be a kind of this contract will come through within 1 year. So since there is no indication, the deferred tax asset, I mean, what was initially concluded at the time of acquisition date would be more relevant. That deferred tax assets continue to be not recognized. Okay, so that's the answer. So we'll just go through the answer. So Ind AS 103 allows up to 1 year period to remeasure the fair value in case enough evidence is not available on the acquisition date. So that's well taken. But however, the remeasurement is allowed only if any indication is available on acquisition date, and within 1 year, if it becomes certain, then remeasurement can be done. So there should be some kind of indication should be available on the acquisition date. So then if those indication becomes more certain, then a remeasurement is allowed. Otherwise, a remeasurement is not allowed. So in the given example, enough evidence was not available to recognize DTA. That significant order will be backed or not, that was there was no such indication at the time of acquisition date. However, within 1 year, there is sufficient evidence made available. So since there is no indication as on the date of acquisition, the remeasurement is not allowed in this case. So initial goodwill is 50 million INR, but no remeasurement is allowed. So how this 50 million INR came? The purchase consideration is 150, but preliminary assessed fair value of net assets is 100. So 150 minus 150 is the excess consideration paid. So that will continue to be accounted as goodwill, and no remeasurement is allowed post the acquisition. Okay, so then let me move to the next example. Yeah, just read through this question. I will summarize the question here. Yeah, so here ABC acquires XYZ on 15th Jan 2021. On the acquisition date, there exists an unsettled claim by a customer. Okay, and ABC did best estimate to measure this liability and concluded at 1 crore. And on 1st October 2021, which is the post acquisition, the liability measurement is revised to 2 crores. And further on 5th 2022, the liability further remeasured at 1.9 crores. But however, ABC concludes to keep contingent liability at 2.2 crores. So there are different numbers are available and different dates are available. But from remeasurement point of view, let's go through this. So goodwill needs to be remeasured as there was an indication of claim. So as on the date of acquisition, there is a clear evidence that the claim was there. Only thing is settlement not happened, but there is indication of the claim. So maximum period allowed as per Ind AS 103 for remeasurement is within 1 year. So the remeasurement done on 1st October, that is at 2 crore, would be more relevant, and accordingly goodwill to be remeasured considering the liability at 2 crores. Okay. And the opening balance sheet as of March 2021 needs to be restated. So this is important. So you have the balance sheet as of 31st March 2021 based on the initial liability of 1 crore, but that 1 crore needs to be restated to 2 crore, and your opening balance sheet as of 31st March 2021 needs to be restated by taking into account the liability at 2 crores. Yeah, so this is allowed as per Ind AS 103. Okay, I hope it's clear. Then let me go through the next example. So in this example, Progressive Limited acquires Regressive Limited on 30th July 2022, and purchase consideration is fixed at 500 million. And there is existing litigation case filed by Regressive Limited against Progressive Limited. The initial recognized liability was 10 million. The revised estimated liability as on the acquisition date is 20 million. Right? Okay. So now the answer is, as on the acquisition date, if any existing transaction between the two parties needs to be dealt with separately. So here there is a claim as on the date of acquisition. So that claim, whether a business combination happens or not happens, that liability will remain. So that has to be dealt separately and not to be clubbed along with the business combination entries. So assuming the purchase consideration of 500 million includes the litigation settlement as well, then the net purchase consideration should be only 480 million. So we'll have to consider only 480 million for all the accounting of business combination. So 500 million is the total consideration, and fair value of the litigation as on the date of, estimated value as on the date of acquisition is 20 million. So 500 minus 20, only 480 million will be considered as the purchase consideration. For all the business combination accounting purpose, the purchase consideration should be at 480 million. And Progressive Limited should further increase the litigation liability from 10 million to 20 million. Okay, then let me move on to next example. So in this example, KKV acquires 100% of Viva and purchase consideration is 20 million USD plus another 2 million USD will be payable after 2 years only if the below two conditions are met. So first condition is the company should ensure EBITDA. EBITDA means earning before interest, tax and depreciation allowance. After 2 years should be 21%. And second condition is the former shareholder of Viva to continue the employment for at least 2 years. So these are the conditions. So now let's look at the answer. So the purchase consideration, we have to take only 20 million USD. So that's the fixed purchase consideration. And the remaining contingent consideration of 2 million USD should be accounted as other employment cost. So that should not be included as part of the business combination consideration. So it's all the contingent consideration should be dealt separately. On acquisition date, the provision for other employment to be created in the books of KKY, and on settlement, if any delta that needs to be accounted for in this case. So in this case, the 2 million USD should be provided on the date of acquisition by KKV. That 20 million, sorry, 2 million USD should be created as the other employment liabilities. And when it is actually settled, it may be 1.9 million or 2.1 million, we don't know. So based on that, the actual liability should be accounted. So the delta, if any, needs to be taken into the income statement. Okay, then let me move on to the next example. So in this example, ABC acquires XYZ and XYZ has three shareholders, two employee shareholders and one is the non-employee shareholder. And purchase consideration includes 60 lakhs to employee shareholder and additional consideration of 1.5 crore to 2 crore based on the earnings of the company over the next 2 years, and their employment to continue for a minimum 2 years. And the non-employee shareholder will receive 1 crore. So now let's see how this employment related consideration needs to be accounted for. So the relevant Ind AS para is B55A of Ind AS 103. So here the contingent payment will be considered as post combination service and to be included as the employment cost. So it should not be included as part of the main business purchase consideration. So any contingent payment based on the employment contract that needs to be accounted separately as the employment cost. So in the given example, the contingent consideration of 1.5 crore to 2 crore will be the post combination service related to payment. Okay, then the firm employment liability of 60 lakhs to the employee shareholder and 1 crore to non-employee shareholder, that should be part of business consideration and it should be included when you calculate the purchase consideration. Okay, then let me move to the next example. So in this example, Green Limited acquires Pollution Limited and Pollution Limited has existing unsettled equity award to its employees. The vested period is 5 years and 2 years already expired as on the acquisition date. So as per acquisition terms, it is agreed to replace the equity award with shares of Green Limited. The revised vesting period is 2 more years from the acquisition date. The fair value of award by Pollution Limited is 500 per share and of Green Limited is 600 per share. So this is what it has been given. So now let's go through the answer. So when arriving the purchase consideration, Green Limited to include its share value, that is 600 per share, into number of shares vested. The original vesting period is 5 years and original award value is 500 rupees. So out of 5 years, 2 year is already expired. So 2 out of 5 on the fair value of 500. If you apply, you will get 200 rupees. So this 200 rupees is a fair value as on the date of acquisition, and this should be included in the purchase consideration. And the remaining 400, that is 600, is the total fair value as estimated by the acquirer. Out of 600, 200 is already accounted as part of business purchase consideration. The remaining 400 should be accounted as the employment cost post combination by Green Limited. Okay, so basically we are dividing the total fair value into two. So total fair value is 600. The 600 needs to be divided into pre-combination and post-combination. So for the pre-combination, we have to take the the vesting value as estimated by the acquiring, which is 500, and out of 500, 2 years is already over. So 2 out of the total 5 year is over. So 2 by 5 into 500 will become 200. So 200 relating to pre-combination, and remaining 600 minus 200, remaining 400 will be post-combination. So pre-combination should be part of purchase consideration, and post-combination should be accounted as the regular expenses. In this case, it's the employment expense. It should directly get to the income statement. Okay, so let me go through the next example. So in this case, P Limited acquires Q Limited, and Q Limited has existing share-based payment scheme. And as per this scheme, employees of Q Limited will get shares if they complete 5 years of service. And as on the acquisition date, employees have completed only 2 years of service. As part of acquisition term, the vesting period has been reduced from 5 year to 4 year, meaning the remaining term is only 2 years after the acquisition date. The fair value of the award as on the acquisition date is given at 500 per share. Okay, so in this case, P Limited is not replacing the share-based option with its shares. So this is the main difference from the previous example to this example. So here the acquirer is not providing its shares. Acquiry share will be given to those employees who will be eligible for the share-based payments. So meaning at the time of exercising the options by employees of Q Limited, so only shares of Q Limited will be allotted to them. So this create minority interest. So minority interest means in a company, majority is held by the acquirer, and still there is a remaining share. Those remaining share will be called as the minority interest, or also called as the non-controllable interest. So the purchase consideration will be adjusted to this extent. Okay, the share value of the expired period is out of 500, 2 year is expired. Sorry, it should be 2 by 5. So 500 into 2 by 5 is equal to 200. Okay, so this 200 will be allocated as non-controllable interest as on the allocation date. Similarly, the post combination fair value will be 300. So the total fair value is 500 and 200 is pre-combination value, and remaining 300 will be the post combination value, and this post combination value to be included as employment cost in P Limited. Okay, then we'll go through the next example. So in this example, Classic Limited acquires 60% equity of the Natural Limited, and purchase consideration is fixed at 97.5 crores. The fair value of the net assets of Natural is 150 crores, and book value is given as 120 crores. And fair value of non-controllable interest of 40% given as 65 crores. Right, okay, so let's see the answer. So here it has been given the book value of the net assets is 120 crore, and 60% controllable interest share comes to 72 crores, and 40% non-controllable interest comes to 48 crores. Similarly, fair value of the net assets as on the acquisition date, total is 150 crore, and 60% share is 90 crore and 40% share is 60 crore. And fair value as part of the business combination. So there are two fair value, one fair value as per the valuation report, and second fair value as agreed as part of the business combination by the acquirer. That's 162.5 crore, and 60% share comes to 97.5 crore, and 40% share comes to 65 crore. So here there is a situation of goodwill because the fair value being paid is 162.5 crore, but the net assets taken over is only 150 crore. So 12.5 crore will be goodwill, right? And here we also need to refer para 19 of Ind AS 103, where it is stated that the non-controllable interest to be measured at fair value. So in this case, it should be measured at 65 crores. Okay. So then, what is a journal entry should be made? So here, the fair value of the net assets acquired is 150 crore, that should be debited, and the goodwill 12.5 crores, that also needs to be debited, and non-controllable interest at fair value 65 crore, that needs to be credited, and the investments of 97.5 crore, that needs to be credited. So the total of debit and credit will be 162.5 crores. Okay, but we also have another method that's being said as part of Ind AS 103 para 19. There, the non-controllable interest can also be valued at the fair value. So there you can see there are two fair values. One, the fair value as estimated by the acquiree, and second, the fair value as estimated by the acquirer. So, so we have the option. So we can account the non-controllable interest either at the fair value as measured by the acquirer or as measured by the acquiree. So that's up to the option of acquirer. So if we measure the non-controllable interest fair value as per the acquiree, then the journal entry at the time of consolidation will be the fair value of net assets 150 crore. There is no change, that needs to be debited, and the goodwill will be the balancing figure 7.5 crore. I will come to that. And credit of non-controllable interest will be only 60 crore. That's the fair value as estimated by the acquiring, and the investment will be credited by 97.5 crore. Okay, so if you see the credit side total 157.5, and debit side we already have 150 being the fair value of the net assets. So remaining 7.5 crore should be goodwill. That's a balancing figure that will be debited. Okay, so with this I will conclude today's class. We'll again catch up in the next class. Thank you.